The market is vulnerable to an even larger pullback. To break this down for us, we've got Kevin Gordon, Charles Schwab, Senior Investment Strategist, here with us. Kevin, just walk us through the thesis here on a larger pullback and what you're expecting here.
Well, I think it's really because, we've gone through now a pretty extended period of time with sentiment running really hot. This really started back in sort of mid-November when you had, major indexes and most stocks actually in each index really rebounding strongly off of that October 27th low. And then you shot quickly into extreme optimism territory across an array of sentiment indicators we track both on the attitudinal and the behavioral side. So whenever you get in that territory, you are vulnerable, but you can kind of need a negative catalyst to push you in that direction. We would argue probably at this point it's related to yields, but it's also related to what's going on in terms of, maybe a repricing of Fed policy. So, when you think about oversold statistics like the number of stocks that are above a certain moving day average, whether it's the 50-day, whether it's the 200-day, you can kind of go down the list and see that we haven't yet probably gotten to that full rinsing phase. So maybe we push a little bit lower to wring out all of that sentiment. But I still think, the upside is that you're in an uptrend still. So you're in a stronger position when you were sort of entering this correction, if you want to call it that right now. It's still a little shallow, but you were in a stronger position entering into that than you were in prior instances last year.
So then should this still be viewed maybe as a buying opportunity? We talk about the fact that we're seeing a bit of a pressure here across the broader markets, at least over the last couple of days. It still maybe is a strong entry point then for investors?
Yeah, I think it depends where.
Yeah.
I mean, when we came into 24, even with the strength that you had seen across, an array of sectors in October, November, and then December to finish out the year, you had a lot of catching up to do for a considerable chunk of the market. I mean, when we came into 24, about half of the S&P 500 was still trading lower than where it was in January of 2022. So, and a lot of that was concentrated in deeper cyclicals like energy and financials and industrials and even materials. So I think that there's still a lot of catching up to do there, especially if the cyclical parts of the economy, notwithstanding some of the weakness in this morning's housing data, if you continue to see the roll through of the recovery that we've seen in areas like manufacturing and the goods part of the economy, then yeah, I think there's probably more sustainability to that trend. But not without some choppiness as we've been figuring out over the past week.
Banks kicking off the earnings season here. What is the theme that you're sensing right now among these major financial institutions that could prevail for the rest of this earnings season?
I don't cover individual stocks,
Sure,
but just looking at some of the commentary, there's, I think, enough idiosyncratic pressure, but also, benefits, I would say, if you look at some of the misses on net interest income, as you were talking about with Madison, or, looking at the provision for credit losses, it looks different in each report. So I would pay more attention to that, kind of the overall health of the consumer.
And it seems like that comes back to a demand theme as well.
Absolutely. Yeah, absolutely a demand theme, especially because labor has been relatively resilient over the past couple of years, really since the Fed started hiking. So I think keeping that in mind, where even when you move down the wealth or the income spectrum, spending can remain pretty strong because they rely more on their actual month-to-month spending or their month-to-month income than they do on a pre-existing stock of wealth.
Kevin, what's your read on the consumer right now? And I bring that up just because overall from the bank earnings that we got last week, they were pointing to a very strong consumer. Bank of America reiterating that this morning, but also just noting some weakness that we are starting to see. Do you think we're going to see a little bit more of that as we continue with this higher for longer rate environment? And then what does that ultimately portend, do you think, for the markets?
I think it just happens sort of in a rolling fashion. We've talked a lot about this where you have seen pockets of the consumer weaken a lot, but to some extent it's really been concentrated up the wealth and the income spectrum because you look at a lot of layoff activity. It's mostly been in sectors that are higher paying, kind of tech, financial services, consulting, business services, which is rough for those sectors. But when you consider how much they rely on their actual month-to-month income, it's not as much as something that skews lower on the income spectrum. So I think that you can still get relatively solid retail sales prints like we got yesterday. You can still get relatively solid consumption as long as labor as a whole remains intact, but it's not going to be without some chop. But we also have to consider the fact that there are sectors that went through pretty massive layoff and labor cutting cycles last year, and now we're going to probably benefit from maybe more hiring later this year if they do see demand kick back in.
When you think about the catalysts right now that are weighing on the market and where perhaps investors out there are getting a little less bullish, where there's still some, of course, bullish sentiment that prevails right now, but they're trying to figure out what the next big catalyst is going to be. Is there a clear one that's emerged yet?
It might be inflation related. And I say that just because when you start to look at flow data for at least the equity universe, which is what I cover, where I sit. I think that you're starting to see a little bit of a convergence where there's some actual dollars being pulled out of sort of the tech, communication services, consumer discretionaries of the world, and then into, I guess, if you want to call it the reflationary trade of, energy, to some extent financials, maybe industrials. You're starting to see that slightly, though. I think there's still such a bias towards these areas that have led for a couple of years and done really well, albeit energy is still the leader since January of 2022, so that's worth noting. But, some of the larger cap, growth-oriented parts of the market are still really popular, especially as a haven trade. I mean, we have to keep in mind that in this cycle, there are a lot of differences in terms of what's considered traditionally defensive. So looking for companies that have more cash and have strong revenue growth, don't have to rely on or are not hit as much by the moves in longer term interest rates, they're a little bit more insulated to the macro environment right now. So we've still seen investors kind of pile into those parts of the market for safety and for defense.
Kevin Gordon, Charles Schwab, Senior Investment Strategist. Great to see you this morning.
Good to see you guys.
Thanks so much for taking the time ahead of the opening bell.